Ladies and gentlemen, good evening. Imagine for a moment the global monetary system is a vast ocean. For decades, many currencies have floated on that ocean, anchored by faith, by promises, by policies. But what happens when those anchors begin to loosen, when the ship of fiat money, driven by ever-increasing supply and unseen structural pressures, starts to drift? Today, I want to share with you why I believe that gold, that ancient, timeless metal, is not just heading higher, but heading toward a massive revaluation, possibly toward prices that many today would call unthinkable. And I will walk you through why, in my view, 24,000 gold is not a fantasy, but a real possibility, a natural outcome of our current monetary architecture. When we look at the global economy, it is critical to understand that money is not just a medium of exchange. It is a social contract built on trust, faith, and confidence. For centuries, civilizations have issued currencies, and for just as long, those currencies have risen and fallen based on the underlying belief in their value. In modern times, what we call fiat money, currency without intrinsic commodity backing, depends entirely on the willingness of people, institutions, and nations to accept it in exchange for goods and services. That trust is fragile, and it is under constant pressure from the policies that govern the creation and distribution of money. Central banks, in their effort to maintain economic stability, often engage in practices that expand the money supply far beyond the growth of real economic output. They do this with the intent of stimulating demand, supporting employment, and preventing deflation. In theory, it is a rational response to a slow economy. By increasing the amount of money available, they lower interest rates and make borrowing cheaper, which in turn encourages spending and investment. But when this process continues for long periods, the consequences compound. The system is designed to respond to cycles of growth and contraction, yet the repeated infusion of liquidity gradually undermines the purchasing power of the currency itself. The erosion is subtle at first, often masked by rising asset prices, but it is cumulative and inevitable. What happens over time is that the value of money, when measured against real goods and services, begins to decline. People start noticing that their dollars, euros, yen, or other fiat currencies buy less than they did a decade ago. In parallel, the central bank continues to assert that their policies are necessary, that inflation is under control, and that the currency remains strong. There is a paradox here. The more authorities print money to solve economic problems, the more they unintentionally weaken the very foundation of trust that gives money its power. The paradox creates a tension between nominal prices, which may appear stable or rising, and real purchasing power, which is quietly declining. In such an environment, individuals and institutions begin to search for assets that can maintain or increase in value relative to the weakening currency. This is where gold historically reasserts its role. Gold is not tied to a promise, a ledger, or a government policy. Its scarcity is tangible, its history is long, and its acceptance is universal. When trust in paper money falters, the fixed supply of gold becomes a refuge, a benchmark against which the true value of fiat is measured. It is not just a speculative asset. It is a natural consequence of a monetary system in which confidence is gradually eroded through the expansion of money beyond the growth of tangible wealth. The psychology behind this cycle is crucial to understand. People are forward-looking. They anticipate the devaluation of money before it fully manifests in everyday prices. When central banks increase liquidity, the effects are first seen in asset prices, not necessarily in consumer goods. Stocks, real estate, and commodities may rise, giving the impression of wealth creation, but this is largely nominal. Real wealth, measured in terms of tangible goods or enduring assets, often lags behind. Savers notice that the interest they earn on deposits does not keep pace with the effective decline in purchasing power. Investors recognize that holding cash, while seemingly safe, is increasingly risky in a system that incentivizes its own dilution. The cycle feeds on itself. As trust in currency erodes, people demand more of the assets that protect against devaluation. Central banks, seeing markets respond to their policies in ways that are unintended, asset bubbles, inequality, speculative excess, may double down on liquidity, believing that more intervention will stabilize the system. But in reality, each intervention pushes the system further along a path where money's value is disconnected from its original purpose. The more money is created, The less it reflects true scarcity, the less it reflects scarcity, the more people seek alternatives. And as alternatives, primarily gold, but also other hard assets, become more desirable, the cycle accelerates. This is why periods of aggressive money creation often precede substantial revaluations of real assets. Gold is a clear example, but it is part of a broader pattern in which any asset that represents enduring value scarcity or utility will eventually rise in response to the weakening of fiat. History demonstrates that this is not speculative theory. It is observed in every major monetary regime where excessive currency creation was employed without restraint. The outcomes are predictable, not in terms of exact timing, but in direction. The relative value of money declines and tangible stores of value rise. It is also essential to recognize that this cycle is not purely economic. It is deeply human. Trust, confidence, and perception are as important as supply and demand. When people believe that money will continue to lose value, they act in ways that reinforce that expectation. They move capital, adjust pricing, hedge against risk, and seek protection in assets that cannot be printed. This reflexive behavior, the feedback loop between perception and action, magnifies the consequences of monetary policy. It is a delicate balance, and history shows that it rarely remains stable indefinitely. Understanding this cycle is not about fear or alarmism. It is about awareness, preparation, and strategic thinking. The expansion of money supply, the erosion of fiat strength, and the resulting pressure on real assets like gold are logical outcomes of a system that is designed to manage crises in the short term, yet inadvertently sows the seeds for long-term revaluation. Recognizing the signs, anticipating the dynamics, and positioning accordingly is not speculation. It is a disciplined response to the realities of human behavior and monetary mechanics. When we examine the global financial system, it is clear that the dollar occupies a unique position. For decades, it has served as the primary reserve currency, the standard against which many other currencies are measured, and the backbone of international trade. This status did not emerge by accident. It was built on the foundation of America's economic size, its political stability, and the widespread confidence in its institutions. But currency supremacy is not permanent. Like all social constructs, it relies on collective belief and confidence, which can change over time as policies, debts, and geopolitical realities evolve. The strength of the dollar is fundamentally linked to both perception and reality. When investors, governments, and corporations believe that the dollar is stable and that U.S. assets are secure, they hold dollars and dollar-denominated instruments. That belief reinforces demand, creating a self-reinforcing cycle. Confidence drives demand, demand supports value, and value maintains confidence. Yet when policy decisions, fiscal deficits, or monetary expansion erode the perceived integrity of the dollar, this cycle can weaken. Even subtle signs of instability, such as sustained trade imbalances or ballooning national debt, can shift sentiment over time. As confidence declines, other currencies and assets become relatively more attractive, and the dollar begins to lose its unique allure. One of the most significant consequences of dollar weakness is the shift in global reserves. Nations hold foreign currency reserves as a safeguard against shocks, to manage exchange rates, and to support trade. Historically, the majority of these reserves have been in dollars, reflecting both convenience and trust. But as the dollar's relative strength diminishes, central banks begin to diversify. They allocate portions of their reserves to other major currencies, commodities, or tangible assets that maintain value independent of U.S. monetary policy. Gold, with its fixed supply and historical role as a store of value, often becomes a primary beneficiary of this diversification. It is not speculative. It is a rational response to changing relative values. The dynamics of reserve diversification are powerful because they create a structural, long-term pressure on markets. When central banks and sovereign wealth funds allocate significant portions of their reserves to gold or other assets, they reduce the liquidity of dollars in the system while simultaneously increasing the demand for tangible or alternative assets. This is not a temporary effect. It is strategic, deliberate, and cumulative. Every shift in reserve allocation sends a signal to markets about perceived risk, monetary stability, and the future direction of currency values. It is, in effect, a reflection of collective global judgment about the reliability of money as a store of wealth. Dollar weakness also interacts with global trade in profound ways. Many commodities, including oil and industrial metals, are priced in dollars. When the dollar declines, these commodities become cheaper for foreign buyers, stimulating demand and influencing global pricing dynamics. At the same time, countries that hold significant dollar-denominated debt see the real burden of repayment increase if their own currencies weaken less rapidly. The interplay between currency values and trade balances and debt obligations creates a feedback loop in which weaker dollars influence not just asset prices, but broader economic and geopolitical outcomes. Furthermore, the psychology of dollar weakness is amplified by perception and precedent. Markets are forward-looking. They do not react only to current policy or economic data, but also to the anticipation of future trends. When investors expect that the dollar will continue to weaken, they act preemptively, they hedge, they diversify, and they reallocate into assets that can preserve value. Gold, as a universally recognized and scarce asset, becomes a natural destination. The cumulative effect of these shifts is not linear. It accelerates as momentum builds, feeding on both real demand and anticipatory action. The historical record illustrates that reserve shifts are rarely sudden. They develop over years or decades, yet the impact on asset values can be dramatic once the movement reaches a critical mass. Dollar weakness combined with strategic reserve diversification has the potential to create substantial upward pressure on tangible assets like gold. It is not a matter of speculation or hype. It is a predictable outcome of the interaction between confidence, policy, and scarcity. Those who recognize the structural forces at play understand that the market is responding not just to immediate conditions, but to a long-term recalibration of value and trust. Finally, it is important to understand that this process is not purely economic. It is also geopolitical. Nations are aware that the concentration of global reserves in one currency confers both power and vulnerability. As trust in the dollar fluctuates, countries may strategically diversify to reduce exposure, enhance independence, or hedge against political risk. These decisions are deliberate and strategic, and they influence market behavior in profound ways. Over time, the dollar may retain its dominance, but it is increasingly being tested by structural pressures, competing currencies, and the natural human desire to protect wealth against erosion. In this context, gold emerges as both a stabilizer and a signal. It reflects a recognition of potential risk in fiat systems, a hedge against instability, and a store of value independent of government policies. Dollar weakness combined with global reserve diversification does not guarantee immediate price movements, but it creates conditions in which revaluation is not just possible, it is highly probable. Understanding these dynamics, anticipating the flows of capital, and recognizing the interplay between confidence, policy, and scarcity allows one to navigate the system strategically. The lesson is clear. Currencies rise and fall not merely because of economic fundamentals, but because of collective trust, perception, and behavior. Dollar weakness and global reserve shifts are two sides of the same coin. They illustrate how faith in money drives behavior, how strategic responses shape markets, and how tangible assets emerge as the ultimate measure of enduring value. When we examine the forces that shape markets over the long term, one cannot overlook the role of central banks and institutional actors. Their behavior is not driven by short-term speculation or emotional impulses. It is guided by long-term strategy, risk management, and the need to maintain stability in a world full of uncertainties. Central banks are tasked with managing national reserves, ensuring liquidity, and protecting their economies from shocks, whether they arise from inflation, currency volatility, or geopolitical events. Because of this, their decisions carry weight far beyond the immediate financial impact. They shape perceptions, influence flows, and signal future trends. In times of economic uncertainty, when confidence in paper money erodes and the world faces structural imbalances, central banks often turn to gold as a core component of their reserves. This is not merely symbolic. Gold represents scarcity, enduring value, and universality. Unlike currencies, which can be printed at will, gold is finite. Unlike bonds or equities, which are subject to default risk or corporate mismanagement, gold's intrinsic value is recognized globally. When a central bank decides to increase its gold holdings, it is essentially expressing a judgment about the relative reliability of fiat currencies and the need to preserve real value over the long term. These are deliberate strategic decisions, And they matter because central banks control vast sums of money and their behavior is highly visible to markets. The structural demand created by central banks is cumulative and self-reinforcing. When one major central bank increases its gold reserves, others observe and often follow suit. This is not herd mentality in the superficial sense. It is recognition of systemic risk and prudent diversification. The result is a long-term upward pressure on gold prices. Unlike speculative buying by individual investors, which can be fleeting and volatile, central bank demand is persistent, predictable, and backed by deep institutional knowledge. It creates a foundation beneath which the market for gold is supported. Regardless of short-term fluctuations in price or sentiment, safe haven flows are closely linked to this structural demand in periods of market turbulence, whether caused by geopolitical tensions, financial instability, or sudden shifts in monetary policy. Investors seek assets that preserve value and reduce risk. Gold, by virtue of its history and intrinsic properties, has long served this role. The psychology is straightforward. When trust in currencies, banks, or institutions falters, tangible, scarce assets become the refuge. Unlike other assets that may be affected by counterparty risk, regulatory changes, or technological disruption, gold retains its purchasing power. Its value is not dependent on a specific government, company, or financial instrument. This perception drives behavior, and behavior drives markets. The interaction between structural demand from central banks and safe haven flows creates a dynamic feedback loop. Central banks accumulate gold to hedge against currency risk, inflation, and uncertainty. These purchases signal confidence in gold relative to fiat, prompting private investors, institutions, and sovereign wealth funds to follow. As demand grows, prices rise, which reinforces the perception that gold is a necessary hedge. Higher prices, in turn, attract additional capital, not as a speculative bet, but as a rational response to evolving risk over time. This cycle strengthens the foundation of gold's value and elevates it beyond what would be determined by short-term supply and demand alone. This structural dynamic is particularly significant when considering global imbalances. As economies expand and debt levels rise, central banks face the dual challenge of preserving purchasing power and maintaining credibility. Gold provides a solution to both. It is a tangible asset that cannot be created at will, offering protection against the erosion of currency. It is universally recognized, providing credibility in a portfolio, and its strategic accumulation sends a clear message. Even the most sophisticated institutional actors acknowledge the limits of monetary policy and the potential vulnerabilities of fiat systems. Another layer to consider is the geopolitical dimension. In a multipolar world where power is distributed across nations and confidence in any single currency is increasingly questioned, gold serves as a neutral arbiter of value. Central banks may increase reserves not simply as a hedge against inflation, but as a geopolitical insurance policy. They are preparing for scenarios in which currency alliances shift, economic sanctions disrupt access to markets, or confidence in dominant monetary systems diminishes. This perspective reinforces the notion that gold's value is anchored in its ability to transcend national boundaries, offering stability in an unstable world. It is also important to recognize that structural demand and safe haven flows operate on different timescales but converge in effect. Central bank accumulation is deliberate and slow, moving, often measured in years or decades. Safe haven flows, in contrast, respond to immediate shocks and market sentiment. When these two forces intersect, when long-term institutional positioning aligns with short-term risk-driven behavior, the market experiences periods of accelerated price discovery. These episodes are not random. They are manifestations of deeper structural realities that have been building over time. Understanding the underlying forces allows one to anticipate potential movements rather than react to them after the fact. In essence, the combination of structural demand from central banks and safe haven flows underscores a fundamental truth. Gold is not merely an investment. It is a strategic asset embedded in the fabric of the global financial system. Its price is influenced not only by supply and demand in conventional markets, but by the collective judgments of those entrusted with safeguarding wealth on a massive scale. These forces create enduring upward pressure, resilience in value, and an assurance that in times of uncertainty, gold will continue to play its historic role as a store of value, a hedge against risk, and a reflection of confidence in tangible, enduring assets. When we consider the role of gold in the global financial system, it is essential to recognize that its value is not derived from speculative interest or short-term trends. Gold's significance is rooted in its ability to preserve real wealth across generations, independent of the policies and imperfections of human institutions. Unlike paper currencies, which can be printed or devalued, or bonds, which depend on the solvency of a counterparty, gold possesses intrinsic characteristics that make it an enduring measure of value. Its scarcity, divisibility, portability, and universal acceptance have allowed it to serve as a hedge against the very uncertainties that all financial systems inevitably produce. One of the primary functions of gold is its role as a hedge against inflation. When governments expand the money supply to stimulate growth or to finance deficits, the immediate effect may be economic activity and asset price increases. However, over time, the purchasing power of fiat currency diminishes. Inflation erodes wealth in nominal terms, and cash holdings lose value relative to goods and services. Gold, by contrast, maintains its purchasing power because it is limited in supply and universally recognized. This is not theoretical. It is observable across centuries and across civilizations. In periods when paper money has depreciated rapidly, gold has preserved value, often dramatically so. Its performance is inversely correlated with the real value of currency, making it an essential hedge for those seeking to protect long-term wealth. But gold is not only an inflation hedge, it is also a hedge against uncertainty. The world is unpredictable and markets are subject to shocks that are impossible to fully anticipate. These shocks may be financial, political, or geopolitical in nature, and they often occur in combination. When uncertainty rises, investors naturally seek assets that are reliable and universally accepted. Gold is uniquely positioned to fulfill this need because it does not rely on promises or policies that may fail. It is not exposed to default risk, and it is recognized across borders and cultures. When crises emerge, gold becomes a safe haven, absorbing capital that flees more vulnerable or contingent assets. Its price rises not because of speculation, but because it is a rational refuge in an unstable environment. Systemic risk is another dimension where gold's role is critical. Financial systems are inherently fragile due to interconnectedness, leverage, and the complexity of instruments. Banks, institutions, and governments create and manage risk on a scale that ordinary investors cannot fully comprehend. Yet when these systems falter, whether through credit collapses, policy missteps, or structural imbalances, the effects ripple through economies, reducing confidence and destabilizing currencies. In such scenarios, gold acts as a stabilizer. Its value is not contingent on any single system's survival. It provides a tangible counterbalance to the fragility of paper-based financial networks. Investors who hold gold are effectively insuring themselves against systemic shocks that might otherwise erode wealth in ways that are difficult to predict or control. The interplay of inflation, uncertainty, and systemic risk reinforces the structural importance of gold. These forces often amplify each other. Excessive money creation increases inflation. Inflation erodes confidence, and diminished confidence heightens systemic vulnerability. Gold, by preserving real value and acting as a universally trusted asset, mitigates all three simultaneously. It is both reactive and preventive. Its presence in a portfolio provides protection against losses that might arise from multiple interacting risks. In this sense, gold is not a speculative instrument. It is a strategic asset, a cornerstone of long-term financial security. Psychology plays a critical role in this dynamic. Investors and institutions act on perceptions, expectations, and trust. When they anticipate inflation, uncertainty, or systemic fragility, they allocate capital toward assets that can withstand these pressures. Gold's history and reputation make it an obvious choice. These expectations are self-reinforcing as more actors recognize the need for protection. Demand rises, which further strengthens gold's value relative to more fragile assets. The process is both rational and reflexive, illustrating the interaction between human behavior and market dynamics. Gold is not merely responding to risk. It is a reflection of collective judgment about what constitutes enduring value. Moreover, gold's function as a hedge is not limited to extreme scenarios. Even during periods of moderate uncertainty or gradual inflation, its presence stabilizes portfolios and preserves purchasing power. In diversified portfolios, it provides asymmetric protection When other assets decline due to inflationary or systemic shocks, gold often rises or at least maintains value. It serves as a counterweight, an anchor in times of volatility, and a buffer that allows investors and institutions to maintain strategic positions without panic or forced liquidation. Finally, gold's universality cannot be overstated. Unlike instruments tied to a specific currency, government, or institution, gold transcends borders and regimes. Its value is recognized everywhere, which allows it to function as a global standard of real wealth. This universality is what makes it particularly effective as a hedge against systemic and geopolitical risk. When localized crises occur, gold retains value when global monetary imbalances emerge. Gold absorbs pressure when confidence in currency systems declines. Gold offers stability. It is the ultimate measure of wealth preservation in a complex, interconnected, and unpredictable world. In conclusion, gold's role as a hedge is multidimensional. It protects against inflation by preserving purchasing power. It shields against uncertainty by providing a reliable store of value when the world becomes unpredictable. It mitigates systemic risk by offering an asset that is independent of the fragility inherent in complex financial systems. For these reasons, gold is not a speculative instrument to be traded lightly. It is a strategic foundation for wealth, a compass in uncertain times, and a safeguard against the unavoidable cycles of economic and monetary instability. Its enduring relevance is both historical and contemporary, and for those who understand the dynamics of money, risk, and human behavior, gold remains the most reliable hedge against the forces that erode real wealth. So when I step back and look at the map, when I examine the currents shaping economies, currencies, and global reserves, I conclude this: we are not facing a minor correction or a normal market cycle. We are entering a revaluation regime, the kind of revaluation that only happens once in a generation, when faith in fiat erodes, when institutions pivot, when real value becomes the only safe bet. In that regime, gold doesn't just inch up, it leaps. Now, is 24,000 gold certain? Nothing in markets is certain, but is it a realistic, plausible, and defensible outcome under these dynamics? Yes, it is, because this is not about greed or speculation. This is about mathematics, history, and trust. Trust in real value over paper value, trust in what endures. So for you watching this video, if you sense that the world's monetary compass is shifting, then gold isn't expensive. On the contrary, right now, it may still be undervalued relative to what's coming. Thank you. I encourage you to think long-term, to see beyond the noise, and to prepare not for fear, but for prudence, because history doesn't wait. It rewards those who understand it.